Welcome back to the deep dive. Today we are taking the express elevator down into the fast, volatile, and sometimes brutally instructive world of the Solana ecosystem.
That's right.
You sent us a comprehensive stack of sources detailing one of the most interesting and frankly catastrophic failures of late 2025. We're talking about the implosion of the TUNA token.
We are. And if you're studying the mechanics of high-speed crypto launches, this isn't just, another story of a token that didn't work out. It's a textbook case of how good intentions and, well, clever engineering solutions can create entirely new and fatal vulnerabilities.
So our mission today is to go way beyond just the price chart. We want to understand the perfect storm.
The perfect storm is exactly the right phrase for it. It was this confluence of mechanical design flaws, predictable market weakness, and this underlying psychological pressure. All of it came together to cause TUNA, the native token of the TUNA Launchpad, to lose over 88% of its value.
In just a few days.
In the span of just a few crucial days, yeah.
Over 88%. I mean, that figure is staggering, and we really need to lock it in your mind right away because this project, which launched with, significant fanfare in early December 2025, it showed genuine signs of success.
It absolutely did.
It promised to solve the endemic rug pull problem that plagues so many of these Solana launches, but then by the start of January 2026, it was trading in the absolute depths.
So for any learner out there trying to identify the structural risks that are just baked into these high-velocity launch ecosystems, this is your definitive case study. It's all about how engineered stability can completely backfire.
Okay, so let's set the stage. What exactly was TUN?
Right. So TUNA is identified by its contract address. We'll put it out there for the record. It's GFLD 9EQN7A1. UCHO PYVJJ AGO HKX 14 DFFHO BWAKWA pump. Essentially, it was a fair launch meme coin built to power this new thing, the TUNA Launchpad.
And the fundamentals, the tokenomics.
Pretty straightforward. A total supply fixed at 1 billion TUNA, with the circulating supply sitting just shy of that at about 994.73 million. And you have to understand, this fixed supply is key because the catastrophic event wasn't a supply problem. It was a demand failure against a sudden, massive supply release.
A demand shock. And before that shock, there was a high point. A genuine triumph, it seemed.
A huge one. December 25th, 2025, Christmas Day. The price hits its all-time high, or A8, of approximately $0.001598.
Which translated to a market cap of?
Roughly $1.58 million.
Yep.
And achieving that valuation, even for a moment, you have to understand, that places TUNA firmly in the elite percentile of successful Solana launches. Most tokens on this network, they never even break 5 figures, let alone 7.
So they had the momentum, they had the community belief, and they had what seemed like a really robust mechanism.
And then the drop. It was not only dramatic, but incredibly fast. From that peak on Christmas Day, the price just collapsed. It bottomed out and stabilized in this really low range of about $0.001679 to $0.003.
By early January.
By January 2nd, yeah. The sources are very precise here, noting that the overwhelming majority of that 88% plus decline was concentrated around a single 24-hour window, specifically December 26th.
So this wasn't a slow bleed, it was a depeg event.
A classic depeg event driven by overwhelming selling pressure, a shockwave that the system just couldn't absorb.
Okay, let's unpack the setup because this is where the story gets really fascinating. TUNA wasn't just relying on hype, they pitched themselves as being architecturally superior, right?
They did. Their core value proposition was safety and stability, and they planned to achieve that by using something called bonding curves for their token launches. They were really trying to build a better mousetrap.
A better mousetrap. I like that.
Yeah.
So how does a bonding curve differ from what we normally see?
Well, a bonding curve mechanism is fundamentally different from, say, a standard automated market maker or an AMM pool like you'd find on Orca or Radium. In a bonding curve, the price and liquidity are algorithmically linked. Meaning every time a token is bought, the price increases along a predefined curve, and the underlying collateral like SOL is automatically locked as liquidity. This guarantees that a seller can always exit at the current price. It ensures liquidity grows in lockstep with the token's market cap.
So it's supposed to prevent that classic rug pull scenario where you go to sell and there's just nothing there.
Exactly. It prevents the no liquidity for sellers problem. It's a self-managing system intended to create steady upward momentum based purely on buy volume. But they didn't stop there.
Right, they added two distinctive features marketed specifically to prevent volatility and flash dumps. What was the first one?
Feature number one was the headline grabber, the 60-minute exit protection mechanism. This was their big attempt to apply a kind of behavioral engineering to the launch process. The concept was simple, but pretty radical.
Okay, so what was it?
For early buyers, after they entered the curve, they could not sell their positions for profit immediately.
An enforced cooling off period? But how do they actually enforce that?
It was all programmatic, written into the smart contract. During the 60-minute window, sell orders were restricted. If an early investor tried to sell, the system would calculate the max they could get back, and that was capped at their original entry price, minus gas fees.
So you could get your money back, but you couldn't profit.
Precisely. You were protected from a loss.
Yeah.
You could exit without losing your principal capital, but you were explicitly prohibited from taking any profit during that first hour. It was designed to keep the quick flipper speculators out and prevent that rapid-fire buy-and-dump strategy that often kills new tokens in minutes.
That actually makes a lot of sense. It stops the immediate buy low, sell 5x higher 5 minutes later tactic. But the very idea that you could only exit at your entry price minus fees, that means for 60 minutes, any upward price movement was essentially invisible to you as a seller.
Right. It's a powerful incentive to hold, but you can see how it also becomes a source of, well, intense psychological friction.
And the second feature?
The second feature was designed for the long term, the automatic graduation mechanism. This promised a smooth, trustless transition from that controlled bonding curve environment into standard external liquidity pools on the Meteora DEX.
So they were signaling that this was a long-term play.
That's what they were signaling, yeah. That the team had planned for life after the initial launch phase. It was a clear path to decentralized trading stability. TUNA was meant to be a long-term asset, not just a short-term curve play.
So we have this sophisticated mechanism designed for safety. It leads to temporary success, that $1.58 million APH on December 25th. And here's where it gets really interesting, because we move from the promise to the critical turning point where all these elaborate safety nets just simultaneously failed.
Yeah, let's chart the timeline of the collapse. The initial phase, from roughly December 12th to the 19th, was a triumph of execution. The bonding curve deployed flawlessly. It attracted significant capital. The whole mechanism was validated.
And then the exit protection kicked in.
Right. On December 19, the 60-minute exit protection period officially began applying to that initial token cohort. And for the next week, the feature was celebrated. It was seen as a novel solution to instability.
And as the buy volume continued, the momentum peaked on the 25th. They had successfully navigated the initial volatility with this enforced lockup, reaching a market cap most projects only dream of. The system appeared to be working exactly as intended.
And then came December 26th. This is the date we pinpoint as the DPEG event. And what we found in the data is that this was not a slow decline of interest. It was a sudden, sharp, catastrophic collapse.
And the reason?
A perfect, and frankly, a perfectly avoidable convergence of three massive events that hit the market at the exact same time. It created a selling cascade.
A triple whammy of pressure. What was the most significant catalyst? I think I know the answer.
It's the most ironic one. It was the expiration of the exit protection. Think about all the tokens purchased in the days leading up to the 26th. That 60-minute lockup, which was intended to distribute early exits, had effectively aggregated all potential selling pressure into a massive latent supply cliff. The clock just ran out for everyone at once.
So instead of preventing the dump, it merely delayed it and, well, it concentrated it. That's a huge structural flaw in the design theory, isn't it?
It is. A fatal one, it turns out. But the timing of that release was amplified by two other factors, both executed at the exact same moment, 04.000 UTC on December 26th.
Okay, what were they?
Number two, WEEX executed a spot trading listing for TUNA. And number three, the team announced the full V2 Launchpad release, officially exiting their beta status.
Wait, hold on. They scheduled the unveiling of their brand new platform, a major exchange listing, and the expiration of their primary anti-dump protection, all to coincide at the same specific hour.
All at 04.000 UTC.
That sounds less like strategic genius and more like catastrophic coordination. Why? What was the thinking?
We can only speculate, but the team probably intended this to be a celebratory moment, a simultaneous graduation, listing, and product launch. The listing and the V2 launch were supposed to provide this immense demand boost, enough to counter any minor profit-taking.
But that's not what happened.
Not at all. The market reacted instantly and brutally. Sell orders immediately overwhelmed by demand across all the primary Solana DEXs, Orca and Radium, where the real liquidity was supposed to be. The WEEX listing, poorly timed for global liquidity, was instantly irrelevant. The price collapsed 80 to 90% in less than 3 hours.
So the timing is everything here. The problem wasn't just the V2 launch or the listing itself, but the expiration of the lockup happening at the same time and the complete failure of the other events to provide a sufficient counter-demand shield.
Exactly.
Okay, let's spend the necessary time dissecting these root causes, starting with the biggest irony of them all: the exit protection backfire.
This is the TUNA lesson in behavioral economics and market game theory. A feature that was explicitly designed to prevent early dumps ended up creating a giant, synchronized selling event. We're calling this the psychological pressure cooker effect.
That phrase is spot on. It really captures how behavioral mechanisms can undermine engineering. I mean, if I bought TRNA on December 24th, watched it pump for 2 days, and knew that I was temporarily locked out of profit, I wouldn't be feeling safe. I'd be feeling anxious.
Anxious, right? Knowing that your selling opportunity was finite and that it was shared by thousands of other investors who were all thinking the same thing.
That the rational move is to sell first.
The rational move is to sell first, and fast. The lockup mechanism was a forced accumulation device for selling pressure. Every early buyer was rational. They saw the high market cap of 1.58 million. They knew that valuation was purely speculative, and they understood that the moment the restriction lifted, everyone else would try to sell.
So it created a collective, predictable point of forced synchronized exit. It guaranteed a massive supply wave at that exact moment.
They traded early stability for guaranteed concentrated catastrophe later. It was a structural time bomb, and they set the timer themselves.
And when that time bomb exploded, it brings us directly to the second technical cause: the insufficient liquidity architecture. No matter how much demand the WEEX listing should have generated, if the plumbing wasn't there to absorb the sell orders, the price was doomed from the start.
Correct. We have to look at the architectural transition. TMA's liquidity pools on Orca and Radium were established as part of that automatic graduation feature. And while the team described them as respectable at launch, that term is highly misleading in this context.
They weren't respectable.
They were completely and utterly insufficient to absorb the coordinated, instantaneous selling volume that was released when the exit protection expired.
This highlights a crucial danger zone for any token using a bonding curve, doesn't it? The curve itself provides guaranteed internal liquidity managed by the algorithm. But when you transition to an external DX, that dependency shifts completely.
It does. And the vulnerability lies in the fact that tokens graduating from bonding curves often transfer to external DACUPS pools with minimal seed liquidity, the amount of actual capital, usually SOL, that's paired with the token to facilitate trading.
How minimal are we talking?
The sources highlight that many tokens graduating this way rely on what are sometimes described as mathematical placeholders for external liquidity. In TUNA's case, the external liquidity support was shockingly low. Sometimes it was backed by the equivalent of only approximately $35 worth of SOL.
$35, not $35,000.
$35. $35 SOL.
You have to imagine the sheer disbelief and panic of an early whale investor who put in, say, $50,000, seeing their position theoretically supported by the equivalent of a small family dinner fund. That's not a foundation, that's a paper napkin.
It is functionally zero liquidity support for a token that had just peaked at a $1.58 million market cap and was now facing a massive synchronized panic sell.
So explain for our listener, what does that mean in practical terms?
In an external AMM pool, liquidity depth dictates how far the price moves when a buy or sell order executes. If the liquidity is thin, like $35 worth of SOL, even a single moderate sell order for, say, $500 can lip out the pool's entire balance and just crash the price exponentially.
And TUNA faced thousands of these orders all at once.
All synchronized. It proves that the architectural transition from the controlled, self-managing environment of the bonding curve to the chaotic open market was fatally flawed. They designed a beautiful clock, but the moment they tried to take it out of the box, it just dissolved.
And this leads us right into the third cause, which is purely contextual. TUNA's failure wasn't just internal, it was amplified by a really weak ecosystem sentiment at the time.
Yes, cause 3. Broader Solana memcoin market stress and the cold, hard reality of failure rates. For our learner, it's crucial to grasp that TUNA was struggling within an already stressed environment. Late December 2025 was not a bullish time for speculative assets.
Not at all.
The broader market sentiment was weak, and that just magnified TUNA's specific errors. We can look at the benchmark. PUMP, the native token of Pump.Fun, the dominant meme coin launchpad, was already in decline. It dropped 35% in December alone, despite the team's desperate efforts to stabilize it.
Wow. So if the largest, most successful, and most liquid platform is seeing its native token bleed 35%, what chance did a new entrant like TUNA even have?
Essentially none. The PUMP scenario demonstrated that even the most aggressive, well-funded stabilization programs, and we'll get into those details later, they just cannot compensate for a systemic lack of underlying demand and weak market sentiment. TUNA launched, peaked, and collapsed into a market that was already actively selling off the existing dominant players.
And if we really want to talk reality, we have to look at the statistics the sources provided regarding the probability of success in this ecosystem. It's a huge reality check.
The numbers are incredibly sobering, and they define the structural risk here. I mean, consider this. Pump.Fun is this machine that's generated over 11 million tokens. Of those 11 million, the success rate for graduating to a standard DX like Radium is only 0.6% to 1.4%.
So over 98% of all tokens fail at the first major hurdle.
Over 98%, it's staggering.
You have a higher chance of being struck by lightning than having your project successfully graduate from a major Solana launchpad.
Pretty much. And it gets even tighter.
Okay.
Of that tiny 0.6% that do manage to graduate, only 0.3% of those ever reach a significant $1 million market cap in subsequent trading.
And TUNA, remember, hit 1.58 million.
They were a temporary statistical unicorn. They beat impossible odds just to reach a very precarious peak.
A precarious peak built entirely on speculation and that psychological pressure cooker of the exit protection.
Exactly. And the ultimate success metric, a token exceeding a $10 million market cap that has a probability of approximately 1 in 100,000. TUNA's peak was elite, but the historical data confirms it was built on an unsustainable foundation of speculation that the market was just statistically programmed to reject.
This data just demonstrates the inherent structural risk of the asset class itself. It's wild.
It is.
So let's move to the combination of smaller factors, causes 4, 5, and 6 that really combine to deliver the final crushing blow. Let's talk about timing, specifically the market weakness around the Christmas holiday.
This is a classic operational failure. The period from December 24th through the 27th is universally recognized as the weakest for global crypto trading. It just is.
Why is that?
Well, institutional money is largely offline, professional traders are on leave, and global trading volume just contracts dramatically. The market depth shrinks. It's fundamentally thinner, which means any large sell order is going to cause disproportionate chaos.
And the decision to execute the WEX listing on December 26th at 04.00 UTC just made it worse.
It exacerbated, yeah. That time slot is notoriously weak for generating meaningful liquidity overlap between Asian, European, and Western markets, particularly during the holidays. So the listing completely failed to generate the necessary counter demand. It was the worst possible moment to launch an aggressive demand mechanism.
And it coincided perfectly with the moment of peak accumulated supply from the expired exit protection.
Perfectly. It sounds like operational negligence, or at the very least, extreme naivete about global market cycles.
So they failed to respect basic market mechanics. And finally, let's discuss the lack of clear utility, which explains why the price drop was so absolute.
This is the floor giving out. The token's stated utility was staking, governance, and fee sharing from the launchpad. But here's the fundamental issue. Without verifiable on-chain evidence that the soon-to-be-launched V2 launchpad would generate substantial creator volume and subsequent fees.
The TUNA token lacked any fundamental value support.
Exactly. When the speculation retreated, which the expiration mechanism guaranteed it would, there was no tangible asset, no revenue stream, and no audited metric to justify a price floor above zero. The valuation of $1.58 million was priced on pure expectation.
And when expectation met the reality of that synchronized exit dump?
The price had nowhere to stop at the sub-$200K market cap range, which was the market's brutal assessment of its true zero utility value at that moment. This is why we say the market always finds the point of maximum accumulated pressure. TUNA built a mechanism that aggregated all the pressure, scheduled a weak point for release, and provided no fundamental floor to catch the fall.
What's fascinating about this failure, though, is what happened next. Despite the catastrophic price collapse, the Build Tuna team's response has been the complete antithesis of a typical rug pull team. They didn't vanish.
No, their actions post-collapse are a crucial piece of this puzzle, and they argue strongly for technical legitimacy over malicious intent. The team stayed visible and immediately focused on rigorous product development.
They kept building.
They kept building. They released V2.01 Live and then followed up quickly with V2.02, incorporating bug fixes and loading improvements within days of the disastrous launch. This demonstrates real engineering capacity and a clear commitment to their product roadmap.
Rapid iteration in the face of near-total financial collapse. I mean, that speaks volumes about their long-term vision, even if their market execution was deeply flawed.
It does. They also tackled the infrastructure problem head-on. They had to execute website capacity upgrades because even the post-collapse user traffic surge was overwhelming their initial server setup. Another sign of technical competence.
And they tried to directly stabilize the price through active visible buybacks, right?
Yes, multiple buyback transactions were executed by the team, all transparently visible on SolScan. They were trying desperately to provide some price support.
Yeah.
And while these efforts ultimately failed to halt the dominant selling pressure,
Because the market weakness was systemic.
exactly. But their actions showed genuine, continued intervention and commitment to the token's survival. They even went public with a full roadmap publication on December 20th, trying to inject concrete future plans into a narrative that was just dominated by failure.
So if the price has collapsed, but the team is building, what exactly were they building in V2 that they believe could justify a recovery? What's the hook?
V2 is focused entirely on driving verifiable volume and, crucially, fee generation. The key highlight is the integration of a perpetual trading feature, which promises up to 125x leverage trading for Solana tokens directly on the Launchpad platform.
Wow, 125 times leverage. That is
Yeah.
aggressive. That is designed to attract professional, high-volume, high-risk traders, not your average retail meme coin buyer.
That's the idea. The theory is that this feature, if executed correctly, can generate significant platform fees, not just from trading commissions, but especially from liquidation fees in such a high-leverage environment. High volume means high fees, which ideally flow back to TUNA holders.
And there was a creator reward system, too.
Yes. It involves a 1% creator fee and a 1% system fee, with distribution mechanisms that pay out to the top 200, 300 holders every 24 hours.
So this whole structure is aimed at solving that utility problem we just talked about. By giving TUNA holders a verifiable, immediate cash flow mechanism, it links the token price back to active platform usage.
That is the hope. The strategy is to turn TUNA from a speculative asset based on promises into a utility asset supported by verifiable platform cash flow.
But, and this is a big but, despite all this rapid development and demonstrated technical capability, one core issue remains a massive confidence deficit. It comes back to trust and transparency.
And that's the crux of why many in the community still view this project with extreme skepticism. The Build Tuna team remains largely pseudonymous.
So we don't know who they are.
We don't. Our sources indicate a dedicated internal structure, at least one primary developer architect, 4 additional developers working on complex features like their perpetuals infrastructure, and a community lead. They're clearly organized and capable.
But if they are so competent, why did they engineer the liquidity architecture so poorly in the first place? And more importantly, why the continued pseudonymity?
That's the critical question, and it underscores the trust deficit. Their competence suggests the liquidity failure wasn't due to a lack of skill, but maybe a profound miscalculation in market execution and timing. As for the pseudonymity, in the Solana ecosystem established, successful projects often emphasize doxed or publicly verified teams as a non-negotiable trust signal.
And TUNA's lack of public identities just prevents any independent assessment of their track records or prior professional conduct.
It does. So their technical output argues against a typical rug pull, but the lack of faces and verifiable history means the project relies entirely on faith in their future execution, not their past reputation. It's an internal contradiction that just splits the community right down the middle.
How did that split look on, say, X-Twitter?
It was stark and immediate. You had the supportive voices championing the legitimate team narrative. Their argument was powerful. A team intending to exploit the project would have sold their holdings when the market cap was comfortably above $1 million on Christmas Day.
Right. They would have cashed out at the top.
Exactly. The fact that they stayed, continued to build, and executed visible buybacks suggests legitimacy and commitment to the V2 roadmap. They believe the price collapse was an external market failure combined with a poor feature design, not malicious intent. They're focused on the product's long-term value.
And the other side?
The skeptical voices were far more numerous immediately following the crash. Many investors cut their losses after the 88% decline, rightly focusing on capital preservation. Their concerns were foundational: the viability of yet another new meme coin launchpad, the lack of team transparency, and most importantly, insufficient information on the unit economics.
The actual revenue versus the operational cost.
Right. For the skeptics, it was purely a speculative play that failed, and the team's commitment didn't change the fact that their investment was decimated. The commitment is meaningless if the token has no value.
And that profound sentiment gap is where TUNA sits today. Long-term believers hoping V2 pans out versus traders who just categorized it as high-risk speculation and got out.
That's the divide.
To fully grasp the structural challenges TUNA faced, we really need to compare it to the giants of the ecosystem. This brings us to the comparative dynamics with Pump.Fun, because the TUNA collapse was amplified by the fact that even the market leader was struggling.
Yeah, Pump Fund is the structural benchmark. It's the dominant force, having generated an astonishing $755 million in lifetime revenue and launched over 11 million tokens. It defines the success model for this niche. But even this giant is deeply vulnerable to systemic market forces.
Okay, let's dive deep into the PUMP paradox, because this metric just illuminates the absolute structural limits TUNA was up against. Tell us about their buyback program.
The PUMP paradox is this. Pump.Fun established a mechanism to allocate 100% of its massive platform revenue to buybacks of its native PUMP token. And in December 2025 alone, they executed $32.7 million in buybacks.
Wait, say that again. $32.7 million.
$32.7 million, dedicated solely to providing price support, absorbing sell pressure, and signaling confidence. That is an institutional-level commitment.
And what happened to the price?
Despite that $32.7 million infusion of liquidity and demand, the PUMP native token still declined 35% during the exact same month that TUNA imploded.
A 35% decline, even with $32.7 million actively trying to halt the selling. That number is stunning. It suggests the selling pressure was so pervasive and systemic that even the most well-funded intervention was completely insufficient.
The implication for TUNA, which has a tiny fraction of that platform revenue and fee base, is crystal clear. They faced structurally impossible headwinds.
Yeah.
The PUMP example proves empirically that team buybacks alone are utterly insufficient against sustained ecosystem-wide selling pressure.
Or a synchronized market shock like the one TUNA experienced.
Exactly. Buybacks are temporary price support. They're not a fundamental price floor. TUNA's small, well-meaning buybacks were essentially just noise against a tidal wave.
This analysis really synthesizes everything. We have a mechanical flaw that aggregated pressure, a catastrophic lack of liquidity, and a weak market context where even the giants were sinking. So let's summarize the key systemic takeaways for our learner about navigating this Solana market.
We can crystallize this experience into 3 structural realities that have to inform your approach to these high-speed launches. First, exit mechanics matter. The TUNA lesson is profound. Innovative features designed to enforce stability can backfire spectacularly if they ignore human psychology. You have to distribute selling pressure gradually, not accumulate it.
The moment you create a shared, predictable exit window, you guarantee a synchronized dump. You essentially engineered a doomsday clock for your own valuation.
That's a perfect way to put it. Second, valuation disconnect. We established that the vast majority of Solana meme tokens trade purely on speculation. When that speculation retreats, the valuation has no floor unless it is supported by verifiable revenue. TUNA's $1.58 million valuation was based on hope. The crash was the market reverting to the true value of its unverified utility, which was near zero.
You have to look for platform cash flow, not just market cap.
Yes. And third, liquidity architecture is critical. The transition from the controlled environment of a bonding curve to the open, volatile world of external DX pools is the most dangerous phase for any token. Minimal liquidity pools, especially those backed by mathematically insufficient capital, like the $35 OFO in TUNA's case, make these assets extraordinarily vulnerable. The failure wasn't in the bonding curve itself, but in the subsequent unprotected exposure to the market.
These are harsh but absolutely necessary lessons for anyone looking to enter this specific corner of the market. So let's look at the final status of TUNA as of January 2, 2026. After this total collapse, where does the investor stand now?
Well, the current trading metrics reflect a low confidence and extreme volatility. The market cap fluctuates dramatically, ranging between $175,000 and $755,000, which indicates extremely low liquidity. The 24-hour trading volume is also minimal, sitting between 163K and 277K. It's a tiny, volatile asset, currently held by approximately 3,000 wallet addresses.
So if you're a new entrant looking at TUNA today, is it a deeply discounted utility play because the team is still building, or is it just a discounted risk?
It remains firmly in the category of a high-risk, speculative investment. It is appropriate only for investors who are fully comfortable with the probability of a 99% loss. The holder base is still split. You've got the long-term believers holding for the potential utility of the V2 launchpad and hoping the perpetual trading features deliver.
And the others?
The new entrants are viewing the current collapse price as a speculative buying opportunity, a bet that the team's visible commitment will eventually translate into real platform revenue.
For our listener who might want to follow this project, maybe as a case study in recovery, what are the key verifiable monitoring points to assess TUNA's future viability? What should they be watching?
There are three critical things you must monitor, and they have to be verifiable on-chain, not just announced in a roadmap. First, actual creator, volume, and fee generation on the V2 launchpad. Does that 1 in 25x perpetual trading feature actually drive substantial, sustained activity? If the platform doesn't generate massive verifiable fees, TUNA's utility remains zero.
Volume equals utility. Got it.
Second, improvements in team transparency. Does the team ever decide to dox or publicly reveal the identities of the leadership? Increased transparency would act as a massive immediate trust signal. It would distinguish them fundamentally from the vast majority of anonymous, failed projects in this space.
And third,
Sustained platform adoption. Does the aggressive 125x perpetual trading attract sticky users, or is it just a flash in the pan? Are the V2 features successfully graduating new projects that don't fail immediately? If the core product doesn't work, the token is simply irrelevant. The project's success depends entirely on making TUNA an asset supported by platform cash flow.
and right now, the odds are not great.
Right now, the odds, based on historical data and structural market weakness, are intensely stacked against it.
So here is where this entire deep dive culminates for me. TUNA attempted to engineer trust and stability into a fundamentally speculative asset class through this innovative lockup mechanism. The failure wasn't just an execution. The team proved they were technically capable. The failure was perhaps in the core assumption itself.
What's that?
Can any mechanism truly stabilize a coin built on pure speculation? Or will the market always find the point of highest accumulated pressure and exploit it?
That is the ultimate question this deep dive presents, isn't it? The exit protection mechanism was a fascinating, if misguided, attempt to impose discipline on a market that just rejects all attempts at control. I'd encourage the listener to observe the subsequent performance of other launchpads.
To see what they learned from this?
Exactly. Will they double down on innovative but potentially dangerous mechanisms like TUNA's, or will they acknowledge that in the meme coin world, fundamental utility and genuine transparency are the only true, non-engineered forms of exit protection? That lesson applies far beyond the fate of a single Solana token.
A tough but crucial lesson in market mechanics, human psychology, and architectural failure. That was a deep dive into the catastrophic collapse of TUNA. We'll see you next time.